Welcome back, everyone, to VIP Traders. You're in the Sandpit here with Sandy. Tonight we're going to be going over the MACD, also known as the Mickey D. Firstly, I just want to talk about why we use it, what it's for, what it does, and we're gonna break it down a little more and go into how to read it and what it means when it's going up, down, sideways. There's lots of little things you may not know about. So this is what this is here for. So basically the MACD is two lines, two moving averages, both at different times. You've got a slow and a fast. And the fast one is basically, the fast line is basically, it's basically the crowd's interest there and then. And the slow line is just interest kind of smoothed out behind it. All right. You can, for those who don't want to, you can read it both ways. You can choose the fast line and trade with that, or you can trade with the slow line if you don't like it being so choppy. The slow line will take out all the ups and downs and it'll just smooth that line over. It's just like using a larger moving average. It gets rid of the choppiness. So first and foremost, you have a zero line. You can see here, let's bring it up. You can see here we have a zero line, which is, it's like anything, positive and negative. I'm not sure what everyone thinks about the positive and negative, but the best time to get into a trade is at its lowest point in the negative. I'm going to take this from a book that I read, but there's 4 seasons to a MACD. You have your spring, you have your summer, you have your autumn, and you have your winter or your fall. And the reason why we do that is the spring is when you sow the crops. It's when you put your trade in. That's where you're going to see the most grow, is in the spring. At its lowest point, get in, ride it up. Summertime, it gets to the zero and passes up through the zero. We call that summer. You can still get in there. You can still get in your trade. It's still okay. And then as it gets to the top and starts to roll over, autumn start to come in. Obviously, they call it fall. It starts to roll over. It starts to fall down. Probably a good time to look at getting out. And then winter. Winter is when that line is going down, and that's where you're in hibernation and you're basically getting ready for the next trade. You're waiting for that spring to come back around and get in the next trade. Okay. Also, you've got the red and green bars, and basically that's just a histogram on volume. It just shows bulls and bears, really. Now you've got, let's take over here, you've got a darker color, whether it be dark green or dark red. Basically that just is showing you who's in charge of the trade at the moment. So dark green means the bulls are in charge. As it becomes lighter, it means the bears are starting to take over. And that's why we say it right up here. This is where fall kicks in. This is where it starts to roll over, and this is where you want to think about getting out of your trade. Same with the red. Dark red means bears are definitely in control. As a trader, what you want to be looking for is this lighter red color. This is where bulls are starting to take back over, and this is where you want to think about getting in a trade. And the other reason we talk about getting in a trade down here, it's a key thing. If you're getting in a trade here, let's just say you want to get in a trade here. Where's bottom? Bottom's all the way down here. You get in a trade down here, you don't have far to fall to the bottom. Does that make sense to everyone?
Yeah. What time frame are you using in this selection right here?
I'm just in the 3-day. I'm just at the moment. This is just showing you an example. I'll break it down, and I'll show you some other cool info on what time frames to use and how to use it. Awesome. Basically, I'm just showing you the MACD here, and some other important keynotes that you may not know is the width apart of these two lines shows how strong that trend is going to be. So see here how it starts off thin, but it keeps spreading apart. It hasn't come down even. It's kind of getting wider and wider apart and wider and wider. That means that it's getting faster and faster as it drops. It's no different to here as it crosses over. They call it a signal or a divergence, where normally it's right where bulls and bears kind of one's taking over from the other. People like to buy and sell off that. You can. It certainly works. There's so many different ways you can trade. Again, it's whatever you feel comfortable with. But as it's coming up, the wider it gets, the quicker it's going, the more bearish it is. The more bullish it is on the way up. And also the angle. Angle makes a huge difference. So let's just throw a line in here. So, 62 degrees. There's lots of different angles you can look at. If you go and put some angles over here, what do we got? We're looking at, 75 degrees. So the steeper that angle, the quicker that's going up, or the more, the more crowd has come to put trades in on that certain stock. And that's what you want to look for. The sharper the incline or decline of those who are going short. Now, Forex, you definitely go, it's either long or short. The better the value of stock, the quicker it goes up, the bigger candles you'll see. The candles also, in relation to here, the zero mark, you tend to not get large candles below the zero. You'll find once it starts to hit over the zero, let's have a look here. I tend to find sometimes when it gets over the zero, you start to see the candle size increase. Maybe not on the daily charts, but certainly in the smaller charts. They kind of start off, and that's basically because it's all with emotions. People are trying to figure out what everyone's doing. Each bar, just say you're in the minute chart, you've only got a minute to fill that volume, and if you don't have a lot of volume, it's going to be a small candle. So the more interest, obviously, you've now gotten above the zero, you're getting more interest, and that's why the candles start to get bigger. So that's what you want to look for as well. And some other indicators, I won't get too much into candles, but indicators that you've either got a turn at the bottom or a turn at the top is all to do with the wick size. You just need to remember that it's like, you could say it's like a cylinder with a plunger in it, all right? And you've got two sides to the plunger. You've got bulls and bears on one side. And if you've got the plunger in the middle and you've got, say, two shafts coming out either end, basically it's either one side or the other. And the longer the wick, the more pressure you have on the downside or upside trying to push that stock down. So that's just another little indicator to look out for those turns. Normally at the tops you'll see falling, they're called morning stars or falling stars at the top when the stock's going to reverse and come down, or at the bottom you'll see a red hammer. Like I said, I'm not going to go into the candles. That can be for another lesson, but you'll see the red hammer at the bottom for a reversal, followed by normally a green doji. So I hope that makes sense. What else can we look for? They also talk about, you don't really want to trade if you're trading long. If the fast line pulls under, you don't really want to be trading long. So, if you wanted to trade down here, sometimes when the MACD is still going down, it's still going up. And that's just because it's in the positive zone. Rule of thumb is you should try and steer away from trading long when the fast line is under the slow line. Okay, just a little bit of a trick there. Just don't get caught. All right. The MACD obviously is a moving average, so it kind of correlates with your moving averages on your screen. Your candles, when they pass through the moving averages on your screen, it's no different to down here. You'll find that the MACD will actually push up through the zero line. Again, they're correlated to each other. So you can see here where we've kind of pushing up through. You can see on the 0 mark here, I'm looking down here, it pushes up through the moving average, brings you into the positive. Just like my moving average webinar, we talk about trading basically off the moving average. You go long when you pass through. Take a pick, whether it be the 20 or 50. When the candles pass through the moving average, you go long, and you wait till it pulls back down through there, and you close your trade. Can work for day trading depending on your time frame, but a lot of the forex guys like to go a little bit longer, and a moving average is a really good tool to use for those longer trades. Definitely hour time frame and up for those big trades. Stuff like that you don't have to watch. And with TradingView, I can right click on my moving average and just set an alert. So if I click on this, add alert, and I can say, hey, when this is crossing down, alert me. And whenever that comes down, if you're not watching it and somehow it drops and it crosses down through that moving average, you get an alert and you can get out of your trade real quick. So tips like that, use your programs to your advantage. So you don't, there's a lot of guys out there, a lot of girls that can't sit there and watch it every day. Pick your couple of stocks and try it. Try moving average, or try moving average trading. Set your alerts, pick a time frame, and go for it. It's actually quite easy. Very different to day trading, where you're really searching for volume and trying to get in and out. Okay, time frames. Time frames with the moving average. Now, let's start the 1 minute. You can start the daily. You can start anywhere you want. Daily is where I look for, daily and weekly where I look for swings. Okay. The rule of thumb with the MACD, I don't know if someone knows, but I try and retain the information I get from books. The rule of thumb is the rule of fives for the MACD, or for your different screens. So if I'm going to use a 1 minute, then I should be using the 5 minute with it. If I'm using the 5 minute, I could use the 10 or the 15. It's kind of got to go in fives. They say for the daily, there's 5 days in a daily, so they use a weekly chart. That's five days. They say that works the best. I like to use kind of the 1, the 5, and the 15. For day trading, any bigger than the 15, it's really too slow. It's kind of when you get into the 1 hour, you're kind of looking at, holding stuff overnight, or going, really riding the waves up and down. But if you really want to get in a trade in and out during the day and find that best spot, then definitely the 1 to 5, and even just double check the 15, because that can also pull you down. And what I mean by pull you down is not going through your different time frames and looking what another time frame is doing, because it can be roaring in the 1 minute, but the 15 is actually below the 0 going down, and it will still go up in the 1 minute. You got to remember it cycles at different time frames. You'll find that it'll actually drop a lot harder than it goes up when you've got some negative pulling it down, which the smaller time frames, they really tend to work with each other. The bigger the time frame, they're a lot slower, and you've got a lot more time to react. So if we have a look at the 1 minute, let's just zoom in here. I don't know where my MACD's gone. There it is. It's not very choppy here. Let's find somewhere choppy. This is a good spot in here. So let's find somewhere where it's gone low. This is what we want to find. This is a not bad spot. Okay. Now, 1 minute. 1 minute shows us 3 waves. And when I talk about good entry is, so you're watching this go down, you're watching. You see how it's dark red. This is all your dark red. So dark red is still, well, I shouldn't say it's still, but it ends here. And you can see we've got this red looking doji here. And you can see the next one pushes down. It's kind of like a hammer. You can see it's only got volume on the top, that means the bulls are pushing it up. You've got the long wick on the bottom. And right on the edge of this MACD here, the smaller this gets, the more the bulls are starting to take over. And this is where I'm talking about spring. Spring is here. If you wanted to nut it down, where's spring? Horizontal vertical line. Spring would be right there at the, I'd say there at the peak. Let's change that color up. Right there at the peak. That's the best spot to get in. Now, it doesn't always work out, but scary. What's the saying? Scared money doesn't make money. All right, this is where stop losses come in. Now you can see the next wave down was a bit lower. All right, you don't know that, but just based on that angle, you could have waited a little bit longer, and based on the angle that that's shooting up, it's a pretty good chance that that trade's going to be kind of roaring. And you can see the bars here are going up really fast, big bars straight away. It's a good sign. So you can ride this up to here. You can see the bars. You got a little bit of a break in the middle there. You can see how it kind of rides the moving averages. Just like support and resistance, the moving averages also work as support and resistance. They'll test whether it wants to push past that price or not. You can see here we've had a moving average crossover, which are my favorite, and that's why we've jumped up. But then right here, as this starts to roll over, you can see the top of it right here. Let's draw a line. You can see it started to roll over and go down. This is where autumn kicks in. All right, and then we ride that through winter, back into spring, and we enter again. Basically, this is how people day trade. Basically off the MACD. RSI is the other one that you use, because the RSI is basically tells you crowd emotion and how much interest there is in this one stock. The MACD just shows you the motions. Yes, it does show you shows you volume. Unless you go and read every single volume bar, then you don't really know how much interest you've got. You can kind of see the average here. So the next one would be there. You'd buy in there and you'd get out here, and so forth. So moving into a higher time frame though, let's go to the 5 minute. And my bars have disappeared. Yeah. See how much smaller on the 5 minute it is. So the 5 minute lined up nice. So you can see how this green here can sometimes catch you off guard where it changes. You've got to be careful of these little parts here. That's why they say wait. If it pushes up through, wait till it comes back down. Take that winter break and then get back in. If we go to the 15 minute, where's my lines? Yeah. You can see in the 15 minute that it was actually still red. That's why trading in a higher time frame gets rid of all that noise. You got to be prepared to see your account red, but this is where the best spot to this would have looked like the best spot to get in. I would have looked at somewhere around here with my other time frames to get in, but again, then you've got the darker red, means higher volume for bears. But the ideal point to get in would have been right here. As soon as that 15 minute went green, you can see the big bar that we've had there. As soon as it turns green, the bars get bigger. So if we put a line on this one, let's see what the 1 minute look like. Let's go back to the 1 minute. You can see that massive jump that we've had. Okay. Like I said, a lot of mistakes people make is just watching the one time frame. It doesn't work, because if you've got a higher time frame, it kind of works like this. You've got a 15 minute cycle. All right, And then you've got, let's just say, a 5-minute cycle. 5-minute cycle. And then if you've got a 1-minute cycle, does everyone get that? But that's just straight. Now, if you've got positive trend, oh, MACD positive, so normally above the 0. Okay, let's just say one minute it goes up, it comes down a little bit, goes up, and this is what we talk about higher lows. This is where you want to be getting in on trades. That's in the positive. Let's just say the 5-minute could be like this, could come down a bit more, could come up, and then the 15, that could just be the 15, just straight over the top, just like that. That's one wave, and then it starts to come down. One thing you need to watch is when you're entering a trade is go to your bigger time frame and have a look what that MACD is doing, where the lines are, and what the volume, the histogram is doing. Because if you've got a 15-minute on the way down and you're like, the 1 minute looks prime, well, you could be doing this, and then you'll find that it'll start to do that. It'll start to pull itself down. The 15-minute will pull the 1 and 5 minute down. Those highs will turn into shorter, and then your lows will become longer. Becomes very choppy. So don't get caught out like that. Make sure you check your higher time frames. When one of us jump on, and normally I'll jump on and show the 5-minute, and the 5-minute it'll basically look like this. Where is one? Let's see if we can find a good one here. Yeah, like this. So normally I'll take a screenshot like this, and the 15-minute will be right here, and this is what I'll be talking about. So right there on that yellow line, I'll be saying this is going to be a great entry. So you can go and check your 1 minute and 5 minute, but you can see when you go to the 5 minute, this thing's already way up in the air. Yeah, we may have missed a little bit, but you can see the 3 minutes giving that same cycle, the same buy signal as the 15-minute. And then the 1 minute is also giving it. So the only time frame that was kind of out of sync was the 5 minute. So the 1, the 3, and the 15 all gave the same buy signal. Don't worry about that, we would have missed that. But there's other ways to track this kind of thing as well.
So what would you say to start with? Would you start with the 15-minute, or would you start with the smaller time frame?
I think a 5-minute is a really good average in there. Sometimes just to slow my pace down, I'll get myself out of the 1 minute frame, and I'll get into the 5 minute or the 3, just to really slow the candles down and just to give you time to think, because you can get your heart rate up when you're trading, looking for that trade and just getting excited about it. And sometimes if you stuff a trade up, your heart rate can still get up there because your adrenaline's pumping, you want to get back in, but everything's moving and you lose track. It's like, when you're starting to get like that, you need to slow down and breathe, take yourself into a higher time frame, and just slow everything down a little bit and just take another look. That's the best advice I can give you there. So you need to, don't sit in the 1 minute all day. When we're looking at charts all day, I go from 1 to 15, and a lot of the times it'll be hour, daily, because all of these things show whether it's going to have momentum throughout the day or not. So don't get stuck in those lower time frames. Go look at the daily, look what the MACD is doing, look what the RSI is doing. Just have a general idea of where that trend's heading as well. Trend can have a lot to do with it as well. If you're in an uptrend, then you know that generally you're going to have a bullish kind of movement. If you're in a downtrend, then you've got to be careful and watch for those shorter. Don't forget, a downtrend you'll always get shorter ups and longer downs. So lots of things to take note of. And this is just one indicator. You've got your VWAP, you've got your moving averages on the screen. A lot of people use RSI. I use a stochastic, and then sometimes when we're really looking into it, we get the what is it called? The Bollinger bloody. I don't know where it is. No, I don't have it up there. I think it's called the Bollinger, and that's the Bollinger Band, and that's just more things to try and find out where it's going to squeeze and whatnot. So how's everyone's understanding on that now? Is that a bit better? Is there something that you didn't know? Did you know all of this? Do you have any questions?
No questions here.
No other questions? So does everyone here know how to track trends? Does everyone know how to draw a trend line? So you move your MACD, you can also track its trend. I'm just going to go over this briefly, a little bit more advanced, but I saw one back here. Yeah, that's a good example. So you're trying to find a trade, and you're wondering what it's doing. All of these are trackable just by drawing an average line through them. You can see how the dips get smaller and smaller and smaller. So where you want to put your trade in is in here. Let's have a look. See that? If you would have put your trade in somewhere at the bottom of here, you would have ridden that to the top. So it's not only your chart are chartable, your MACD is chartable, your RSI is chartable. And over here, you just chart this. It's an average. It's not going to be perfect. Let's check this downtrend out. See, here you've got a divergence. You've got stock going up, but your MACD going down. So, and the reason it's going up is because it's still in the positive. But normally they go the opposite direction and track down. Here you can find out where this uptrend's going to end just by putting some lines on there. So you trade from there. You wouldn't get back in until it hit down there. You've got to kind of, unless you're riding a larger time frame, you'd want to be getting in, or if you're riding the moving average, you've got to get in and out on each bottom because you don't know if it's going to drop down through. And then you can see here where it's dropped under into the negative, that's where you'd close your trade. There's no point trading this when it's flat like this. No point. If you go to the daily, you can see huge trends on the daily. Massive trends. What's this one look like? You can see one through here, roughly through there. Let's see what that looks like. You can kind of see that massive uptrend through here all the way. And then it kind of levels out. So different techniques you can use to catch those trades. Different techniques to know when to get out of trades as well. You're just using the MACD. You've basically got to watch what it does. Big dips mean it's going to come down. And you just got to watch as the dips become smaller. That could be the reversal of a trade, or that could be where you get in a trade. So if no one's got any questions about it, I'm going to leave it at that. I hope that gives everyone a lot more understanding of MACDs and how we use them, why we use them, and some other ways we can draw lines on them and track them with what they're doing. Cool. All right. Thank you, and good night.